It's in law. I mean, the ink is dry all over the Western world to fleece investors everywhere. And it doesn't matter whether you have 10,000, 10 million, or a billion. It doesn't matter. If your institution goes down, you're toast. Get out of the system. Because when this happens, you're not going to have access to your cash. You're not going to have access to your stocks, your insurance portfolio. You're not going to have access to anything. And even if you did have access, you'd be down 60, 70, 80, 90% if you were able to sell.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 16th through March 23rd, 2026, while supplies last. First this week, 1 ounce gold buffalo are just $199 over spot. 1 ounce silver maples are just $5.99 over spot. Next, 90% U.S. constitutional silver dimes and quarters are $1.50 below spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always glad to have this widely followed returning guest. Bill Holter, a former Wall Street branch manager and a analyst of all markets, joins us today, Friday, March 20th, 2026. Bill, thank you for coming back on Liberty and Finance.
Thanks for having me done again.
You're sought out by our viewers. They'll search around and try to find you anywhere they can because they value your common sense, boots on the ground type of approach, your no-nonsense approach to calling them like you see them. Right now, we're seeing unprecedented volatility in both the gold and silver markets. We're seeing it in the oil markets. We're seeing every day new types of escalation in different hemispheres of geopolitical strife. You've spoken with me recently about this could be the beginning of the unwind of the whole system, which you frankly have talked about that phenomenon and the fact that it's inevitable at some point for years. Can you bring us up to date on what you're watching that leads you to that statement?
I think really what's of concern, the canary in the coal mine right now is private credit. I mean, that's blowing up. You've already seen commercial real estate get hit, and obviously the debt behind that. But the private credit markets, there's 3 or 4 hedge funds now, sponsored by big name banks, Blackstone, BlackRock, that have gated investors. In other words, you want $100 out, but they'll only give you 7. Or you want $100 out and you can't get any. So it's a problem. And from an additional standpoint, it's a mental problem because that's the way bank runs get started. That's what happened in the California banks, 2-3 years ago. And those came out of nowhere. This is very reminiscent of Bear Stearns in February of 2007 with their 3 funds that they gated. And what was it? It took a lot longer than I thought back then. It was a year, call it a year and a half, before everything unwound. But that was definitely a signal as to what's coming. And I think private credit is telling you that also. And on top of that, yields all over the world are beginning to rise.
When you're talking about yields, I think you're talking about sovereign bond yields. Can you explain to people why that's absolutely critical, why you're watching that so closely?
Well, I mean, it's absolutely critical because there's more debt in the world, obviously on a total basis. There's no question about that because the system's bigger than it's ever been. But there's more debt per GDP. There's more debt per any ratio that you want to look at. And when you have a system that's saturated in debt, if you raise interest rates, the system chokes.
And you've talked to us about the concerns of this, as has other market analysts, that the debt market is so much larger than the stock markets, the equities markets, and that spikes in yield that are necessary because of a perceived risk on the part of potential bond buyers drives down, has a negative effect on the value of existing bonds, and that can drive down, start a big cascade decline in all markets. Can you give us a bigger close-up view of that?
I think the perfect close-up view is look at the Federal Reserve, look at their balance sheet. It was just, 3 years ago, I looked at it, and they had $65 billion total in equity holding the whole system up, holding their portfolio up. But they now have a negative net worth. And that's because they unloaded all sorts of called lower rated bonds that they've held on to, and just their regular U.S. Treasury portfolio. As interest rates go up, the bond values or prices go down. And I think they're between $100 and $200 billion net negative equity at this point. And I mean, follow that through to all the insurance companies. The insurance companies, they probably have 60-70% plus of their portfolios are in bonds. And that's what is the bedrock to these companies having value, to these companies being able to service the life insurance contracts, the property casualty contracts, etc. So higher yields and lower bond prices in a over-leveraged system becomes a disaster at some point.
Yeah, it sounds like those phenomenons, higher bond yields, lower bond prices, are kryptonite to the leveraged financial markets that are built, and all the financial edifices that are built on top of those, like insurance, like all the retirement plans and so on, that are going to affect so many ordinary people.
It's the entire system is based on debt. Debt is now the foundation to the whole system. The problem with debt being the foundation is when interest rates go up, the foundation gets thinner and thinner and thinner until it cracks. And just to go one step forward, the reason you want to own gold and the reason you want to own silver is because they cannot bankrupt in a world that is going to completely bankrupt. The foundation of the world, because it's based on debt, and I mean, debt defaults, and debt will default, and that's what people are going to find out, is that there's no foundation under the entire system, both the real economy and the financial markets.
You've warned us about this type of phenomenon and the potential risk of it for years and years. In fact, people have sometimes criticized you or Jim Sinclair, your former partner, for calling the warning sign too soon. But this is exactly what you've been warning us about while there was still time to prepare.
Right. I mean, we were called, we were laughed at. We were called idiots. Being early is not being wrong, because I can see further down the road than the person who's calling me an idiot. Doesn't mean that I was wrong. I was just early. And I'd along the way, we would have events and I would say, this is really bad and has the potential to collapse things. But I was not jumping up and down saying the markets, the world's going to end tomorrow or in 60 days or 90 days or whatever. It's a glide path, if you will.
And I remember an interview with you and Jim Sinclair where the title of the interview was, and I've mentioned this before, it was called "When is Now?" because people kept asking, when, Bill, when? And your answer, I believe, was driven by the importance of making preparedness changes, making meaningful, substantial changes in one's risk exposure of a portfolio. Can you explain why you and Jim were saying, when is now?
Well, because the process was already started. We were already in the process of debt being exposed as a problem. We already knew mathematically there was too much debt in the system. It could not be paid back because the money didn't exist to pay back. And in order to pay it back, they were going to have to create new money supply all over the world, which does what? It dilutes the currencies, creating inflation that ends up as hyperinflation. And what does that do to the credit markets? That destroys the credit markets, which are the foundation to the entire system. So what we were seeing is that the events that were already taking place, people are asking when. When is the day? It's not a day. Yes, there will be a final day where the light switch gets flipped off. But the events that you're watching right now, it's all happening before your eyes.
What is it that you have your eyes on right now that you wish people understood the impact of if you say, look, this is what's happening and this is what's going to follow from that, and you need to understand that, and because of that, you need to get away from this and get over into here. Can you kind of connect those basic dots in the most simple way?
Yeah, I'm just going to give you the biggest dot of all. Get out of the system. Because when this happens, you're not going to have access to your cash. You're not going to have access to your stocks, your insurance portfolio. You're not going to have access to anything. And even if you did have access, you'd be down 60, 70, 80, 90% if you were able to sell. I would just say I've talked about the great taking, 100 times now. Take the hour to read or watch The Great Taking and understand that it's very, very real. It's 100% real. The laws are on the books. When you put money into a bank, you're no longer a depositor, you're a lender. When you put money into a brokerage house, and I just did this, I don't keep any stock at a broker. I did move some stock, I think it was last Thursday or Friday, I brought it into the broker's office, and it was a younger guy, maybe 25, late 20s. And he goes, wow, I haven't seen one of these in forever. And he's talking about the stock certificate. And I asked him, I said, have you read The Great Taking? He goes, what's that? I said, when you go out of business, these shares that I'm depositing, they're gone. They're on your balance sheet. I'm going to lose them. That's why I don't keep anything with you. So it took him about 10 or 15 minutes to go through the process of taking the certificates in. But when he came out from the back room, he goes, I've never heard about that. He goes, really? When I deposit money in the bank, it's not a deposit. I'm a lender. I said, you can bet your ass. It's in law. I mean, the ink is dry all over the Western world to fleece investors everywhere. And it doesn't matter whether you have 10,000, 10 million, or a billion. It doesn't matter. If your institution goes down, you're toast.
What the traditional retort to that claim is, everything's protected by the FDIC up to $250,000 per account. I don't have to worry about that. What do you say when clients give you that?
I would say, I would ask the question, well, let me ask you this. Do you believe that the U.S. government is broke? And 95% of the people, when you ask that question, they'll say, well, of course it is, but it doesn't matter. In this case, it matters because who's the backstop? Who's the insurance company? And I think the biggest laugh of all, and I did an article on this, probably 12 years ago, maybe more, back when CDS was, it was a big thing, and there was CDS, big movements on various sovereign bonds. The biggest joke to me is that there's CDS on U.S. Treasuries. How is that possible? How is an insurance company going to pay for the default of the U.S. government? So, you could buy all the CDS you want. You're not going to get paid.
You're talking now about insurance companies claiming that they're providing a backstop for all kinds of things. In this case, it was sovereign bonds. We've also had that in terms of pension plans. Many companies that had private pension plans in the past and had made promises and commitments to their pensioners that they would continue their payouts, did what they called pension risk transfer. They transferred that risk off to insurance companies. Insurance companies said, yeah, we'll take it on. Yeah, we'll take it on. Don't throw more on our back. We can take more. Because it's a very lucrative business for them as long as the system holds together. But what happened when the kryptonite shows up?
That it's over. If a pension goes out of business or two or three, yeah, they can probably backstop that. Can they do that if the entire system goes? No. It's a joke. Your true CDS, your true insurance policy is physical gold and silver. End of story. Because they cannot default and they are real money. And when this thing goes, you're going to have capital from all over the world trying to find the last safe havens that can't default. And by definition, gold is money and silver is a hybrid money, but neither of them can default. And they will be, and we talk about this, me and Jim talk about this many, many times on interviews. They will be, gold and silver will be the last men standing.
A criticism that's leveled against that by retail investment advisors and much of the financial press is that look at the volatility that we've witnessed just in the past 2 months in gold and silver. How can anybody say that that's something that can be relied upon to be their steady source of core holdings in their portfolio? What do you respond to that?
They've said, don't get into gold, don't get into silver. It's so volatile. And they've said it forever. And I guess, go back to the year 2000. They're telling you, stay out of gold at $300. Don't buy $4 silver. It's just too volatile. Well, guess what? Yeah, it was volatile. It was volatile to the upside. Gold and silver have been the best place to have money since in this century. And it just sits there and sleeps and cannot default.
The types of volatility that we've seen in nominal price for metals, how do you contrast that with the intrinsic utility or the intrinsic value that is unchanging despite those fluctuations in nominal price over time?
Well, first off, and let's go back to what do you say to these people? First off, gold and silver don't do anything. They don't go up. They don't go down. They don't eat. They don't argue with you. You get to sleep at night knowing you're not going to default. What happens is the currencies go up and down, and that's reflected in the measuring stick, in the yardstick. The yardstick is gold. And what the yardstick is saying is that, going back to the year 2000, and let's just use $300. The yardstick says that the dollar has lost 95% of its value, whatever the math works out to be. Since the year 2000, the dollar has lost that much. You could buy 1 ounce for $300, or $1 was 1/300th of an ounce. Now $1 is until a couple of days ago, is 1/5000th of an ounce. Now it's 1/4500th of an ounce. So it's gone up 15-fold if you look at gold going up, but that's not what happens. It's the dollar going down.
For those who are trying to plan a judicious time, a prudent time, a responsible time to add more of this intrinsically valuable asset, gold or silver, to their core holdings, their portfolio, what do you tell people who are watching from the sidelines now and waiting for perhaps further declines that we've seen since January 30th, wondering if this is the right time for them to step in? What's your philosophy around a big picture strategy that people should adopt just to take care of their family's financial future?
Well, gold and silver, and I said in January, gold and silver were due a pullback, without a doubt. And the pullback has been aided by naked paper sales. The naked paper sales have been used since 1975, since the COMEX began. But they really learned in 1987 when the market crashed, because a whopping $6 million is what saved the system. The only options that were open, I think, were not the S&P 500. It was Value Line, or one of the smaller ones. And $6 million went into that, and it saved the market. And what they figured out after that event was that they could bully markets with derivatives to make them go up or to make them go down. And that's what they've done. And there's proof of that. JP Morgan paid $920 million for bullying silver from 2005 to 2013. They paid $1 billion fine. Just understand that if you were thinking about buying gold or thinking about buying silver in January at the peak, with silver, you can buy the same ounce 40-45% less, and the correction has already taken place. I mean, it's not possible for because they can't default, they can't go to zero. And if you look at the demand side, the physical market, the real market, paper markets are the tail, physical markets are the dog. The tail for years and years has wagged the dog. But if you look at the physical markets, silver's got a 450 million ounce per year deficit. And in the words of Elon Musk, you can't short a shortage. And that's what's happening at this point. So once this episode is done, you're going to see, I think it will only probably take 60 to 90 days. You'll see new highs in both gold and silver from wherever the bottom is. And I don't think it's going to be much further from where we are right now.
What about the phenomenon we've seen of collapsing premiums in both pre-33 gold, the semi-numismatic gold, as well as the 90% silver, affectionately referred to as junk silver, the 90% constitutional silver coinage? What's your outlook for, do you see those as screaming opportunities right now for people who are looking to add on? Absolutely.
Yeah, with gold, but particularly in silver, I mean, you can buy it spot or below spot. It's a United States problem because they're U.S. coin, and they're not 99.99 fine, and the demand is for 99.99 fine. It's the demand from the central banks for gold. They're not going to accept 90% gold. They don't want beautiful historic coins. They just want the gold. And with silver is used. Silver is used in industry. It's used in military applications. It's used for medicinal purposes. The green energy stuff. All of that silver's got to be 99 fine. So the reason the premiums have collapsed is because, especially in junk, the premiums have collapsed because really the only way to buy silver back in the 70s and 80s was to buy junk silver. That was the prevalent form for Americans to buy. They sat on it for 40, 50 years. Now they've had a chance to get out. A lot of them did sell, and that selling, brokers only have X amount of dollars. You know, you may have a broker that's got a $50 million credit line, 100, 200, whatever, but that credit line gets eaten up. And because nobody's going to hold junk as inventory, it goes directly to a refiner. The refiner refines it down to 99.99 fine, and then they pay the dealer. Then the dealer gets paid. And at this point, that's about a 6 to 8 week process for dealers to get paid. So that's why the dealers have backed away price-wise, because they know they're not going to get paid for another 6 to 8 weeks. And they're tying up their capital. It's a financial problem. It's not a coin problem. Now, that said, because these things are getting melted down, how much supply is going to be left in 6 months or a year? Because everything that's been sold is getting melted down.
Yeah, you've been separating out the physical market, which is the dog, versus the paper price influence, which is the tail wagging. What is your outlook on this particular question of, given the structural deficit in physical supply versus demand for silver in particular, given the ongoing military hostilities that seem to be escalating and broadening everywhere you look, given the inflationary likelihood of debasing the currency that central banks are likely to do in times of war, what's your outlook for the rest of the year for the precious metals, for people who want to see the way that you see the markets looking forward?
Well, I think I can easily say for both gold and silver, by the end of the year, we're going to be at new highs.
Can you give us some more color behind that?
I'm not going to give you a date. It was just a video put out by John A.G. I don't know if you saw it or not, but he said, Holter's had a perfect track record, blah, blah, blah. The only problem is I'm not foolish enough to give a price and a date at the same time. Now, what I'm saying is, and I feel weird saying by the end of the year, because that's giving a date, and new highs, that's giving a price. But I think 9 months out from now, I think this episode will be far, far behind us. It would only be a blip on what the chart looks like in 3 to 5 years. I mean, if you go back and you look at charts, 2008, 2009 doesn't look as scary as it was at the time. 1987 doesn't even look like a pimple.
For clients who call you and are trying to make first step decisions, what strategies do you suggest to them as far as, looking for a good entry point and then putting their whole nest egg in where they want to, or doing things in multiple steps and tranches over time?
In days past or years past, time past, stepping into it, step by step, doing 5 tranches or whatever, that's a good strategy. At this point, when people ask me how much should I put into gold or how much should I put into precious metals, my standard answer is whatever you don't want to lose. Because when this goes, whatever you don't have in precious metals is going to have a counterparty. And there's counterparty risk. There's going to be a broker involved, or a bank involved, or an insurance company, some type of financial institution involved. And the question is, when the shithouse comes down, is that institution going to survive? And the answer is likely no. So my standard answer is, whatever you don't want to lose, put into precious metals, because they can't bankrupt. And bankruptcy is the future of the world.
Billy, you write on an ongoing basis and you publish videos, you interview around. If people want to stay connected with you and benefit from your seasoned perspective as things continue down what looks like it's going to be a very eventful year, how should they do so in addition to your visits here?
Right. You can go to my website. It's billholter.com. And you can contact me through the website, or you can go directly to my business email. It's bholter@proton.me.
Well, we are grateful always for your presence here. And folks, if you don't want to miss a single episode with Bill on Liberty and Finance, he's gracious enough to grant us an audience on a recurring basis. Make sure you're on our free mailing list. Just go to libertyandfinance.com, put in your email address, click submit, and that'll get you on our mailing list. After you agree by responding to the first email you get says you got to opt in. Once you opt in, you'll get 1 email per day. It'll include every interview with Bill, with all of our other guests, and any weekly specials. You won't miss a thing. Bill, thank you so much again for joining us here on Liberty and Finance.
Thank you, Dunnigan.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for March 16th through March 23rd, 2026, while supplies last. First this week, 1 ounce gold buffalo are just $199 over spot. 1 ounce silver maples are just $5.99 over spot. Next, 90% U.S. constitutional silver dimes and quarters are $1.50 below spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.